Hello everyone. Majority of the investors in Indian share market loses money not just because of the volatility of the market but rather due to their own mistakes. Everyone commits mistake whether they are the beginners, experienced or expert investors. In this video I'm going to share top 5 mistakes for each experience level investors so that you can relate with them for your own portfolio and avoid committing them. Let us start with the top 5 mistakes that beginners commit in the Indian share market. So the first is lack of basic knowledge. Beginners often start investing without understanding key concepts like risk, valuation, or business models. They rely on hearsay or influencers instead of researching the fundamentals, which leads to poor stock choices and avoidable losses. Number two is no stop loss strategy. Without a predefined exit plan, beginners hold on to the losing positions for too long, hoping for a turnaround. This emotional bias prevents rational decision making and can wipe out capital very quickly. Number three is chasing past performance in a stock or mutual fund. If it has recently performed well, beginners assume that it will continue to do so. They ignore whether the reason for that performance still exists. They ignore the technical analysis like the resistance, etc., which can lead to disappointment when trends reverses. Next is the all-in-one investment approach. New investors often put all of their money into a single trending stock or sector, assuming quick gains. Now, without diversification, a single negative event can lead to significant capital erosion. And finally, the herd mentality. Many new investors buy stocks just because everyone else is buying and they do not want to caught up in FOMO. Influenced by friends, media, or online hype, they follow the crowd into bubbles without evaluating the company or the market condition. So these are the top 5 mistakes that the beginner level investors made. Now let's move on to the top 5 mistakes that experienced investors commit. So the first one is the overconfidence, quite obvious. Due to some early wins, the experienced investors overestimate their skills. This leads them to take bigger, riskier bets without adequate analysis, often resulting in bigger losses. Number two is the penny stock hunting. So, low price stocks look attractive because they are cheap, but many, in fact, most lack fundamental or are subject to manipulation. Experienced investors often fall into this trap thinking that they have found a hidden gem and it would turn into a multi bagger in a near future. Moving on to number three, which is the poor diversification. Experienced investors sometimes cluster their portfolio around one sector or theme like IT or PSU. A sector downturn can severely impact their portfolio if it is not properly diversified across industries and asset classes. Now, this point is closely related to overconfidence because the experienced investors think that they know how to read the pulse of the market, and they generally invest a lot in a single sector which they think is going to boom in the coming days, and ultimately which could lead to a major loss to them. Moving on, blindly trusting news is the fourth mistake. Relying on news headlines or TV recommendations, experienced investors often take impulsive trades without verifying the facts or understanding the broader context, often buying high or selling low. Now, this is something which even beginners do, but believe me, experienced investors too do this a lot. And the fifth mistake is the ignoring risk management and leverage. Now, at this stage, many many experienced investors start using margin or F&O trading without risk control. While these can amplify gains sometimes, often they can also result in losses bigger than the invested capital if not handled cautiously. So these are the top five mistakes that experienced investors commit. Now let's move on to the top five mistakes that experts commit. So the first is timing obsession. The expert investors fall into the trap of catching exact tops and bottoms. This results in missed opportunities, excessive trading, and of overcomplicating otherwise sound strategies. Now, this is something which is observed very, very commonly with expert investors, especially those who believe in relatively short term gains or swing trades. Those who believe in long term uh, investment might not fall for it, but definitely those who um, thinks themselves very good in swing trading falls for this uh, timing obsession. Next is emotional bias and probably anchoring as well. Experts can become attached to a stock they have held for years or bought at a certain price. They anchor their expectations to the past, ignoring the present reality of the company or market. Now, this is something which is not quite easily attached to the can be attached to the experts investors, but this is something which has been found in several studies that even expert investors um, commit this emotional bias and anchoring mistake. So avoid this at all cost. You do not own any company, you are not married to any stock. Okay, if it is if it does not make sense to continue remaining in that stock, there is no meaning to be continued in that stock, plain and simple. Moving on, the third mistake is the stale strategy. Now, a strategy that worked in a bull market for several years now may fail in the sideways or bear market. Most of the times the expert investors, they have changed something and customized their strategy, and now they started to believe that their strategy is market conditions volatility proof, but that is not the case more often than not. Experts sometimes resist change due to ego or historical success, which results in stagnation or losses. So even if expert investors, they have their hedge which could actually minimize their losses, but still stagnation is something which they suffer, and which is basically the same capital they could have used in some other investment which would have given them a lot more returns as compared to holding on to this or holding on to a stock or a set of stocks because of this stale strategy. Moving on to the next one, which is the small caps over trust. Now, even after research, experts sometimes ignore red flags like weak promoters, low liquidity, or accounting irregularities in small cap companies, which leads to unexpected portfolio shocks. Now, although it's very simple and looks very easy at the face that you should not uh, trust too much on small caps, especially when you are an expert investor. But believe me, the lure of small caps and the amount of returns that it could give, uh, the potential for a multi-bagger or the potential for multiplying the money is extremely high in small caps, and that is the reason why even experts fell for it sometimes. Although, if you see the history of the 20 years history of the returns, small caps are underperforming. Even large caps have a greater return in a 20 year span in the Indian share market. Anyways, moving on to the last mistake, which is the over diversification. Now, trying to play it safe, experts may hold too many stocks, sometimes even more than 50 stocks at a time, making it almost impossible for them to track or manage them effectively. This dilutes returns and adds unnecessary complexity to their portfolio. So these are the five top mistakes that the expert investors make. Now, it is evident that every investor, irrespective of their experience level, makes mistake. What matters is how quickly you learn from them. Make sure to learn from others' mistake and not wait to commit before learning about them. This is how successful investors make money in the Indian share market. So that is all from my side in this video. Thanks for watching it. If you have found this video helpful, this information helpful, if you have learned something new in this video, please like, comment, and subscribe to the channel. I'll be back soon with another video. Goodbye for now.